All right. So Blockrevision is back after a longer pause than normal. I had some issues with the channel. I had to make some restructurization of elements that I've been working on, and it took definitely time. And on the other hand, sorry for my red nose, I had a fever, so it definitely complicated my approach to some publications. So we are back. As you can find, is it the time for stonks or not? The time that where retails are back and meme stocks have its 5 minutes. But doesn't it mean that when meme stocks are starting to popping up, is it the time to run away? It was always like this. So I would just admit that this time of recent might be kind of a more difficult for market bulls than usual back during previous 3 months, where we were favoring growth right away. This span of time may be leading us to some more difficulties on the way. But today, as always, about stock market indexes, about commodities, cryptos, and today's episode will be much more of a recap rather than the new updates of what's going on, as I'd like to just summarize of what happened when we were off. So let's head over. Alright, so at first let me know whether everything works fine. Recently I had an issue with microphone, as I don't know, this my programs has switched off while I was recording. Hopefully this time everything works fine. So we are heading into next not next, because it's first to the first section, and not bad at all. It's initial claims population level. So inflation right now in US before CPIs is its before CPIs this week is at 6.5%. But the projection is that it will continue to fall due to base effects. So spring months will be compared to periods when fuel prices rose sharply. This is an initial jobless claims, and what we can find here is that we are in a kind of process of bottoming out. But will it recover or even rise further? It's much less likely rather than the fall, but it's still the market, jobless market is pretty stable. So bigger question mark right now that arises is the this concern that the pace of decline in core inflation may cause the market to not prepare in the way it should. So we would say that when the Fed will say theoretically that they succeed and say that their policy is working, we can think about ending raises. But how to reconcile this with the labor market where unemployment is not going to budge? Won't that generate a new wave of inflation then? The question I have for you. So next inflation reports will be crucial. The previous year's base until March will strongly support declining annual inflation, and it's worth watching the prices of used cars, as recently we've noted in 2022 that was a strong decline in the gauges, but right now they are slowly starting to rise again. So it's very interesting. What will be the CPI this week? I highly encourage you to watch this data if you are interested in short to medium term moves on the market. And about the CPIs, always I will let you updated, get you updated on our transmission. So a quick I would say knowledgeable thing that I would like to pose is that we'll start to publish our transmissions. Start our transmissions quarter to 9 a.m. East time from now on in a daily manner. So excluding this recent pause, we are back as I claimed. So getting back to the slide, super strong NFP. That's what previously we have found out from the American economic data. So data strongly strengthens consumption outlook and seems particularly good for the dollar. That's why we have recently seen a spike to the index of DXY, and low unemployment right now still means a risk of increasing wage pressure. What's next? Second wave of inflation. That's one of the headlines that has recently been studied by market analysts. So what about this one? So fuel production in the US is at high level and yet prices are not falling alongside non-housing service inflation. So just look at this. US Bloomberg has CPI core services less housing year over year. At the green is rising, whereas consumers less food, energy dropping, and urban consumers year over year also. But this core services less housing as the one, this green one is the one of the biggest concern. So right now, based on the base value alone, inflation may fall, may still fall, but a second inflation wave of the year is not ruled out. So the Fed is currently giving the most weight to non-housing service inflation, and this inflation remains strongly elevated. Without a drop in inflation, the Fed will remain hawkish, which is not good news for Wall Street, as may be good news for the dollar. So what I mean is that right now, if we compare the behavior of inflation in the US to the credit impulse in China on the other chart, we can find that it can be indicated that in 4 months, around, we should see a trough and a possible subsequent rebound in inflation. So, however, until then, it's still possible to play disinflationary trades. If we just have an indication of China credit impulse and we try to make kind of a confluence with what's going on with urban consumers year over year, it should drop throughout next 4 months, but the next wave is somewhat unequivocal in this view. So recently we had some positive moods on the market, and supply management index is literally skyrocketing. We have been rising to 55.2 points, and it's worth noting the renewed rift with the services PMI. This increase is due to the explosion of the new orders index, and the price index holds right now strong. It's true that it indicates a decline in inflation in services in the second half of the year, but only to around 5%. So that's another gauge that may lead us to lower inflation, but we shouldn't bet on over optimistic scenarios yet. Right now, let's talk about central banks. So at first, Bank of Canada, historically, the Bank of Canada followed the decisions of the Fed. This time, however, it was the Bank of Canada who was the first to decide on the key moves. So Bank of Canada was recently the first to start QT, the first to raise rates, the first to increase the hikes, and the first to reduce the scale of the hikes, the first to stop the hikes. That's what highly expected. That's why we need to watch Bank of Canada to assess what will be the decision of Fed on the economy and interest rates. So Bank of Canada right now in the spotlight. Recently it hiked by 0.25, that has met with also same decision from Fed. That's why it's interesting to track not only Fed but also other banks. For Fed, the Fed raises rates by 25 basis points to 4.5 to 4.75%. There's no end to the cycle yet. Now that's the certain thing. Now what we can find here is that market's expected rate should drop, but it should drop at the end of 2023 right now. However, the Fed is insisting that it shouldn't fall before this year. That's why we have this. I would say this section of those what is Wall Street saying, what's Wall Street saying, and the Fed. That's why we had a drop on the market to I would say to discount this difference. So the data are starting to show more and more convincingly that the current tightening brings elect. However, if Powell announces that the end of the cycle too soon, the market will start betting even more aggressively on interest rate cuts in the fall. Therefore, to maintain credibility, the Fed should just check that while it sees progress for now, it will continue this cycle. So Powell has mentioned he doesn't mind. So he mentioned many times the disinflation that's happening, but he doesn't mind that the market plays, at least by recent week, for cuts. That may be possible. But if inflation quickly returns to the target of 2%, that's off the chart right now. A soft landing, if soft landing may be admitted, and also if the Fed wants to find out about it, as always, you need to bear in mind that Fed is data driven, so there are not all the elements, not of the factors that should impose on this more dovish tone, but we need to be quite updated on what may happen with the market. So the dovish bets was implied by a latest Fed chairman, much less hawkish temper than in December. And as a result, it not only didn't stop the game of disinflation, but also fueled it, and FOMC members now correcting the Powell conference with statements. Fed's bets, as you can find data from the US labor market, significantly changed market expectations regarding the path of interest rates in the US. The peak is currently priced basically one hike higher. Now, what about the ECB? That's right now has dropped euro a bit, and so ECB rejected. Euro rejected this 1.10 level on Euro USD par, and that's why some of the dovish has turned down. Some of the doves has turned down, but right now ECB raised interest rates by 50 basis points, and another such hike should be announced for March, but that's not a foregone conclusion. So we need to be kind of aware that ECB may change its approach, but for now, at least for now, the market is assessing that the ECB will continue rising interest rates by quarter two or even up to quarter three. So the ECB conference recently was even a bit dovish, but maybe the market wanted to perceive it that way. Interest rate expectations practically didn't change, but right now the market expects rates around 3% in 1.5 years. So expectations right after are relatively stable, but we should bear in mind that their ECB stance, it could change up on the way. Yes. So what about Bank of Japan? There is a switch. The market reacted to Kazuo Ueda, that has been elected as the new head of Bank of Japan, quite positively. The current vice chairman, Amamiya, has resigned as a boss, and could it bring some change to Bank of Japan's policy? It's very hard to assess yet. So Ueda was once on the Bank of Japan board and voted against leaving zero interest rates. So it means that by this stance, nothing should have changed. But in June, the market already seen a positive interest rate in Japan, and the market is highly expecting that it may eventually happen. Right now, it should be remembered that the previous decisions on widening the yield curve band were treated by the market as 2 hikes by 25 basis points. So the market will certainly expect stronger changes in the future. So the yen may gain in the coming months, although it will depend on the behavior of the dollar and US yields. All right, we are heading to next data. So booming PMI. What about the global data? So we're gonna find that surprises in the data from the US has brought those PMIs booming. January brings those strong rebound in those gauges, and it was caused mainly by opening of China and being confluenced with Dow in the European economic situation. So recovery in Chinese PMIs may prove to be reasonably durable, if not this COVID-19 wave may reappear. Right, so market outlook, and we are heading into the most interesting indexes. So for this to happen, let me find out. I need you to switch to search to this trading view, and at first let's find out what's happening on DXY. So DXY is becoming pretty stable after this previous week reaction to Fed, to a more hawkish Fed recently. So DXY recently reacted with a quick rebound out of this 100 level, psychologically important barrier, and on a weekly chart also it converges with this downtrend line. That's a upper boundary of this symmetrical triangle that has been formed since 2016. So it's kind of a significant boundary that we should stay above for a while. I would expect DXY to return at least to this 105 or even attack 107 and along the way to 109 if the market will remain kind of scared of upcoming next wave of inflation. So that's about the DXY. What about the major index of SPX? So we are starting to negate this weekly candle that we have stopped at back in 30th of January, and this recent candle may be somewhat somewhat resembling that we should move lower. So on a daily chart, right now the bearishness is reappearing after some of the bearish RSI being built. We should have index moving back to 40 17th area. So that's another possible support we should rebound from. So what about next? It's US 100 that's right now is building somewhat a also bearishness. We can find it. The index right now is trying to get out of this 12.4, but to no avail. Another very important support we should respect is this one at 12.116. So that's the one that I would seek for another rebound and possible long positions. For now, however, we are remaining in a kind of a dovish tone. Okay, so what about Germany? Germany has formed a hammer on a daily basis. Inverted hammer. That's a harbinger of a bearishness coming to the market. Also, we have has exceeded those recent lows, and that means that right now we are entering bearishness, possibly after catching such some liquidity around those levels. We should revert and move even lower to levels of low 15,000s. What about XAU USD? So it's gold. Gold right now is trying to build a power for another move, but I would say that this recent impulse should be one that may persist for longer. And after correction, after some type of correction, we might be heading even lower to the levels of 1800s, and we should stay above it in order to remain in this previous bull tendency. Otherwise, I would expect gold to move back to 1730s. What about WTI USD? So it still looks fine. It still looks like we are in a much more bullishness than the bearishness. But as you can find on a daily, we haven't still yet exceeded, gone through this 200 EMA red line. That should be the first indication of returning to a bull structure for WTI. However, on WTI and RSI, if you want to make an insight more particularly, we can find that we are respecting this trend line on RSI, and it would mean that there is some appetite for return for bulls. But I would expect rather to stay in consolidation for a while yet. In terms of natural gas, right now we can find that we are trying to get out of this bearish box of around 2.40 and 2.50, but this time the bears are still turning up, and it would mean for us that I would rather expect natural gas to move back to levels of 2.4 rather than attack once again levels of 2.7. So for natural gas to return to kind of a bullish mode, I would expect this one to exceed those highs of 2.7. In terms of BTC USDT, right now the bullish mode is right now being expected, but it's kind of a risky to it's kind of risky to bet against BTC/USD on its resistance. And at its support, and I would expect BTC to remain within this area for at least a while. But the next possible support is at 2600. All right, so that was about the most important indexes for now. Right now, let's head into next element, and that will be a retail trader optimism returns. So what is it? What's in it for you? So stock market sentiment turns positive for the first time since April, and that's usually after such a long bearishness. It kind of a much more important to remain cautious rather than over optimistic, as after such bearishness, the bears are still around, flying around, and trying to catch an opportunity to show the market, so and drop the back on you, literally. So that's why you have to remain very cautious, and I wouldn't really buy on the recent highs, at least for now, before any type of bottoming out will form again. What about next market mover section? So we are heading back to our economic calendar this time, and let's head to what's happening and what happened maybe at first last week. So in order to get a broader spectrum, on Monday, February 6th, or maybe I will just get to. All right, I will get you to the 1st of February, as we have stopped recording right there. Unemployment rate from euro area 6.6 instead of 6.5, so it's pretty stable. Manufacturing PMI from US at 47.4, so still below neutral level. Consumer confidence from Switzerland has been a bit higher than the forecast, whereas ECB interest rate decision was at 3%. That's what we've already started. What's next? So we have had unemployment rate at 3.4% from US, and instead of 3.6%, but still this market looks fine. IV PMI from Canada at 60, so it has skyrocketed, literally. We have also talked already about this. Balance of trade, so it's maybe a bit lowerish, but in the US is quite on a stable level. What's next was inflation rate from Germany year-over-year was dropping, so it's positive for euro area. Inflation rate from China at 2.1% instead of 2%, so it's it's skyrocketing, literally, right there. I wouldn't mind if that inflation will be in Europe right now. Anyway, Friday, February of 10th of February, GDP from Great Britain has dropped, and right now GDP still is afraid of some much more shakiness in the economy. And what's next? Consumer sentiment of US was at 66.4. Right now, let's head into this week quickly. And during this week, we have the most important data is this Tuesday's inflation rate. And I would expect to this US 100 to bottom right on the date, and possibly rebound right from the levels I've attached back in the previous section. So we'll get you updated on the issue. Right after retail sales from US and PPIs on Thursday, and that's the most important data for this week. For Tuesday, that's the one thing that you have to be very cautious about, that of the market volatility. What about the earnings calendar right now? So at first, let's head into this week, and right after we'll study what happened back in the previous 2 weeks. So this week we have Fidelity National that's already been published and was better than the forecast. Let's load up another one. Coca-Cola, tomorrow Airbnb, and Marriott. Those are the names worth watching. Cisco on Wednesday, and Glencore and Shopify. Those are the names also of the highest interest. Nestle on Thursday. What's on Friday? On Friday we have Allianz, Daimler, and Electricité de France. So it's out of the French market, also important for this, and Hermes, of course. Those are many of value stocks, most of defensive stocks. So we'll find out how the DJI will perform and whether it will break out of this symmetrical triangle right now it has had found. So what about earnings that already been published previously? We are heading back into this section. So Microsoft revenue slightly better than forecast. EPS decrease, however, a result of margin weakening. Segment growth slowed down from 46 to 38. For Tesla, it's absolutely astounding. Record revenue USD 24.3 billion. Record net profit USD 3.69 billion. So what about IBM, other tech companies? Revenues flat year-over-year. Despite expected decline, EPS growth by 7.5%, in line with expectations, and revenue below forecast for Intel. Revenue expected in 01/23 at USD 10.511. 10.5 should be 11.5. Maybe it was a mistake. Is the lowest since 2010. So absolutely, those are a bit better than expected publications, but the outlook is rather grim than absolutely flourishing. So what about Amazon? Growth in the cloud segment slowed down. Apple revenue down 5%, worse than expected. EPS dropped by 11%, worse than expected. Production in China, strong dollar, production in China, and economic uncertainty negatively affect business. And Alphabet, sales and profit below expectations. So for US 100, the only one determinant I would say right now is this expectations of Wall Street of lowering the pace of hiking interest rates and maybe rate cuts this year. But recently, in the second half of the last week and in the beginning of this week, we could find that many of market speculants started to refute this fury and betting against the market. So it will be very important to watch CPIs of tomorrow. In terms of trade idea, I will jump quickly to TradingView in order to find out what's the most interesting for today. So I would say US 100 is kind of interesting right now, as it has been this high been in line with the recent spike at where we were back on the Friday of 10th of Friday, and I would expect that before CPI we will go downwards, and possible bet from here would get us right from where we are right now, and to maybe I will just take it to 5-minute chart. So right now I would find out that's kind of an interesting pattern and setup to play out, where we have an Eve and Adam top. It's a double top formation, and it would get us. It should get us somewhere to previous highs, previous stop that would be noted somewhere between 1200 and 1210. So I would say this bearishness should remain at least for next 24 hours until at least to next CPI's reports. So in this episode, that's everything. Hopefully you found it's knowledgeable, and I'm just leaving you with this proposition of a trade. But as always, remember about being cautious in terms of taking trading decisions. It's not a suggestion, just a proposition from my own, and we can find that US 100 is the one that should, but only we can speak about only about probabilities, not certainties in the market. So it should move lower, but if that won't succeed, if they get out of this structure, I would rather get away rather than stick to this scenario that it will drop down lower. In terms of risk-reward ratio, it's 4.4, so it's quite decent. So thank you very much for today once again, and see you back on